Welcome to Profit Path, where we turn complex money topics into simple, actionable steps. If you want to learn how to grow your wealth, avoid mistakes, and take control of your financial future, you're in the right place. So, hit that subscribe button now, because your financial freedom starts today. Let's start with why waiting to invest is costing you thousands. Imagine this. Two friends, Sarah and James, both start with $1,000 to invest. Sarah starts investing immediately, adding just $100 a month. James waits, saying he'll start when he has more money. Fast forward 20 years. Sarah's account, over $70,000. James's account, less than half of that, even though he invested more later. Why? Because time in the market beats timing the market. Most people never get started because they think investing is only for the wealthy. But here's the truth. It's for anyone. Most people never get started because they think investing is only for the wealthy. But here's the truth. It's for anyone. And if you don't start now, you'll pay for it later. So today, I'll guide you through everything you need to know, not just how to invest, but how to avoid beginner mistakes and grow your wealth step by step. Why investing matters. Think of investing like planting a tree. It starts small, but over time, it grows bigger than you ever imagined. Why does investing matter? Because it's how your money works for you, even while you sleep. With the right investments, you can retire comfortably, buy your dream home, or fund your children's education without constantly worrying about money. And here's the best part. You don't need thousands to start. Even $5 a week can turn into thousands over time. But here's the danger. If you don't invest, inflation eats your savings. Tell me in the comments, what's your biggest reason for wanting to invest? I'd love to know your goals. Part 2. Understanding the basics of investing. Before you invest, you need to understand where does your money go and how does it grow. There are three main types of investments. Stocks, part ownership in companies, high risk, high reward. Bonds, loans to companies or governments, lower risk, steady returns. Real estate, physical property or REITs, great for passive income. But here's the catch. More reward equals more risk. You can't get big returns without facing some ups and downs. That's where diversification comes in. It's like a fruit basket. If one fruit spoils, you still have plenty left. Spread your investments across different types of assets. That way, if one crashes, your whole portfolio doesn't go down with it. Beginner mistake to avoid. Don't put all your money into one stock. That's gambling, not investing. If you're new, start with index funds or ETFs. They're like a bundle of stocks you buy all at once. Part 3. Creating your investment plan. You wouldn't build a house without a blueprint, so don't invest without a plan. Step 1. Set your goals. Is it for retirement long-term or for a house down payment short-term? Be specific. Instead of I want to be rich, say, I want $500,000 for retirement by age 60. Step 2. Know your risk tolerance. Ask yourself, how would I feel if my portfolio dropped 20% tomorrow? If you'd panic and sell, stick to low-risk options like bonds or index funds. If you're okay riding the waves, stocks might be your friend. Step 3. Pick your strategy. Active investing, picking individual stocks, high effort, high risk. Passive investing, index funds or ETFs, low effort, consistent growth. Pro tip, most beginners win with passive investing because it's easy and beats most experts long term. Tell me in the comments, what's your biggest financial goal right now? Let's inspire each other. Part 4, getting started with investing. Let's break it down, step by step, because getting started is where most people get stuck. Step 1. Open a brokerage account. It's like your shopping cart for investments. Popular platforms, Vanguard, Fidelity, Robinhood. Step 2. Research before you invest. Look at the company's performance, trends in the market, and most importantly, fees. Step 3. Start with what you have. Even if it's $50, it's not about the amount, it's about the habit of investing consistently. Here's a secret. The best investors don't time the market. They stay in the market through the ups and downs. Set up automatic investments monthly, and you'll be surprised how fast your portfolio grows. Comment below. Have you opened a brokerage account yet? Which platform are you using? Let's discuss. Part 5. Managing your investments. Investing doesn't stop once you buy. You need to manage it, like a garden. Step 1. Monitor your portfolio regularly, but don't panic at every drop. Check once a quarter, not every day. Step 2. Rebalance your portfolio. Over time, some investments grow faster than others. Rebalancing keeps your risk level steady. Step 3. Don't chase trends. Hot stocks are like fast food, exciting now, but bad for your health long term. Beginner mistake alert. Ignoring taxes. Learn about capital gains tax. It affects your profits. Bonus tip. If you're unsure about your strategy, get a financial advisor, but choose one who's a fiduciary, someone who works for you, not for commissions. And don't forget, if your goal or life changes, adjust your investments to match. Tell me in the comments, how often do you check your investments? Daily, weekly, or monthly? Let's share our habits. Conclusion. Start now, build your future. Here's the truth. Most people will watch this video and do nothing. But those who take action, even small steps, will thank themselves later. So, which one are you? The one who waits for the right time, or the one who starts now and builds wealth over time? Let's make this a conversation. Comment below. What's the first investment step you're taking after this video?